Right, it's been a big week and there's lots to get through. Coming up, swap rates have dropped sharply, 9 lenders have cut rates, CPI inflation held at 2.8, house prices jumped 3.8% in the year to April, the Bank of England held base rate at 3.75 with two members voting for a hike, and there's a so-called peace deal in the Middle East that, I'll be honest with you, isn't quite what it says on the tin. We're going to connect all of it and tell you exactly what it means for you, whether you're buying, selling, or sitting on a remortgage decision. Stay with me because the market is moving faster than the headlines are letting on. Now, if this kind of insight is useful, please do subscribe. It takes about 2 seconds and it means that you'll never miss one of these weekly updates again. Okay, let's go. Everything in this week's update flows back to one story, so it's probably best that we start there. The US and Iran have agreed what's being called a Memorandum of Understanding. A signing ceremony is scheduled for Switzerland. Markets reacted positively, oil dropped, swap rates fell, and lenders started cutting rates. But let's be honest, this is not a peace deal. It's a list of requirements that both sides are already arguing about. The ceasefire between Iran and the US extends for 60 days. Iran insists Israel forces must withdraw from Lebanon. Israel says it won't. Netanyahu has said publicly he doesn't yet know the full terms of the deal. His own ally just agreed to it. And Israel struck Lebanon the morning the deal was announced. Trump criticised it, and Hezbollah rejected the ceasefire terms as a surrender before the ink was even dry. Meanwhile, the Strait of Hormuz, which is the critical choke point for global oil supply, is supposed to reopen. Markets have priced that in. Oil fell to around $79 a barrel. But, and this is a big but, every single one of those gains could reverse overnight if this ceasefire collapses. If Israel and Hezbollah escalate again, or if the 60-day negotiating window produces nothing. The Bank of England said this in their statement yesterday, almost word for word. Energy prices have fallen since the last meeting, but they remain higher than pre-conflict and have continued to be volatile. So yes, things look a bit better than they did, but fragile is the word that I'd use. Now, I'd love to know, do you think that this peace deal in the Middle East is going to hold? Please let me know in the comments below. Now, let's talk about what the geopolitical picture has done to swap rates, because this is where it gets interesting for mortgage borrowers. Last week, the 2-year swap rate sat at 4.170 and the 5 at 4.188. This week, the 2 years at 4.003 and the 5-year is at 4.021. That's a drop of roughly 17 basis points on the 2-year and 17 on the 5-year in a single week. Now, in normal times, 17 basis points might not feel like much, but in the context of a market that's been sitting on elevated rates since the conflict began, that's meaningful movement. And it happened almost entirely because of the peace deal announcement. Remember, fixed rate mortgages don't price off the Bank of England base rate, they price off swap rates. When swap rates fall, lenders have more room to cut, and cut they have. The flip side, though, is just as true. If that peace deal unravels, swaps go back up, lenders reprice, and everything we're about to talk about gets reversed, possibly very quickly. Now, 9 lenders have moved this week, all in the right direction as well. Nationwide has reduced rates by up to 0.28%. Barclays is cutting across selected ranges. Atom Bank has reduced all rates. Kensington is down by up to 0.25% across both residential and buy-to-let. TMW, the Mortgage Works, has trimmed selected rates by up to 0.26%. Fleet is cutting some rates. Clydesdale is reducing product transfer rates for existing customers. And April Mortgages and Virgin are also reducing. Now, that's a broad spread. High street names, specialist lenders, buy-to-let lenders, all moving in the same direction at the same time. And this matters beyond just the rate headline. 9 lenders cutting in a single week signals that the funding cost environment has genuinely improved, at least for now. Lenders are competing for business. Product choice has already climbed above 7,000 options for the first time since March. Mortgage approvals hit 65,900 in April, and that's the highest it's been in 15 months. The market is waking up. But I'll say the same thing that I always say when we get a run of cuts like this. These pricing windows can close fast. NatWest gave brokers until midnight on a Sunday to submit at the old rates when they changed in early June. And that's how quickly things can move. If you're in the market, you do not want to be the person who waited a week too long. So let me know, are you waiting for rates to fall further, or have you locked yourself into a deal already? Let me know in the comments. So, as expected yesterday, the Bank of England held the base rate at 3.75%. The Monetary Policy Committee voted 7-2 to hold, but that vote split tells a story. Two members, Megan Green and Hugh Pill, voted to raise rates to 4%, and that's not nothing. Two members voting for a hike, not a cut, reflects just how uncertain this environment is. The six members who voted to hold were clear that financial conditions have already tightened significantly since the conflict began. The 2-year fixed rate mortgage is around 80 basis points higher than before the conflict. That tightening is already doing work in the background, slowing the economy and cooling demand. But the hawkish minority argued that the household inflation expectations have risen sharply since the conflict began, that second round effects, meaning inflation embedding itself in wages and prices, are a real risk, and that preemptive rise is now better than a larger rise later. The Governor, Andrew Bailey, was clear that the bank will tolerate inflation temporarily above target given the weak economy, but only if inflation expectations stay contained, and that conditionality is important. The next meeting is at the end of July, and a lot depends on what happens with energy prices and the Middle East between now and then. The base rate being held at 3.75 means tracker mortgage holders stay where they are for now, and standard variable rates don't automatically change. The action for fixed rate borrowers remains in the swap rate market. Now, CPI inflation for May came in at 2.8%, unchanged from April, and below market expectations of 3%. That's the lowest reading since March last year, and it came in the day before the bank's decision, which will have been a factor in the 7-2 hold. The detail is worth understanding, though. Transport was the biggest upward contributor, driven by motor fuel prices and airfares, both connected to the Middle East conflict and oil prices. That's not core domestic inflation, that's an energy shock passing through. On the other side, food and non-alcoholic beverages came in softer, pulling the headline number down. Core CPI, which strips out energy, food, alcohol and tobacco, came in at 2.6%, and services inflation ticked up slightly to 3.7%. That's the number the bank watches most carefully as a measure of domestic price pressure. The honest read here is that inflation looks better than feared right now, but the bank is clear it expects CPI to rise again to a little under 3% in Q3 and a little over 3% in Q4 as energy price effects continue to feed through. The Ofgem energy price cap rises by 13.5% from July. So 2.8 is the calm before a modest storm. It's not a crisis, but it's not the all clear either. Now let's talk about what house prices and rents means for the property market, because the numbers published this week are striking. The ONS reported average UK house prices increased by 3.8% in the 12 months to April 26, taking the average to £270,000. England came in at 291,000, Wales at 212,000, and Scotland at 192,000. But before you get too excited by that number, context matters. The ONS themselves flagged this is largely a base effect. House prices fell sharply in April 2025, just a year ago, after stamp duty changes came in on the 1st of April. And on that note, I've done a recent video on stamp duty and how I think it should be reformed, and I'll put a link to that at the end of this video. But compared to that depressed figure from a year ago, April 26 looks like a big jump. It's partly statistical, not purely organic demand-driven growth. London remains the weakest region with the lowest annual inflation, and prices are down 2.1% over the year. The North East, Northern Ireland and the North West are the strongest performers. On rents, the picture is actually more positive for renters. UK private rent inflation slowed to 3.3% in the 12 months to May, taking average rents to £1,383 a month. That's the slowest pace since March 2022. Rent growth is cooling. The pressure is not gone, but the direction of travel has improved. Now here's the bigger picture that I want you to think about. Mortgage approvals are at a 15-month high. Rates are starting to come down. Rightmove has reported a 0.6 fall in asking prices in June, the biggest June drop in 14 years, meaning sellers are competing for buyers. And as I've been saying for quite some time, that is a buyer's market. But these conditions can flip. If rates continue to fall, more buyers enter the market. More competition means sellers regain leverage. And we could move from a buyer's market to seller's market faster than most people expect, particularly in the sub £400,000 bracket where activity concentrates. So if you're a buyer sitting on the fence waiting for the perfect moment, the window of relative advantage you have today may not be there in 6 months. Now, quickly on unemployment, because this feeds into everything else. The unemployment rate fell slightly to 4.9% in the 3 months to April. Wage growth, excluding bonuses, came in at 3.4%. Including bonuses, it is 4.4%. The bank noted that the private sector wage growth is close to target consistent levels, which is part of why the majority voted to hold rather than hike. A labour market that's gradually loosening and wage growth that's moderating gives the bank room to be patient. For mortgage lenders, stable employment and reasonable wage growth means affordability assessments remain manageable for most borrowers. This is a supportive backdrop for lending. So let me tie all of this together, because individually these are all data points, but together they tell you a story. The Middle East situation has moved in a more positive direction, but it hasn't been resolved. What we have is a ceasefire framework with contested terms, a 60-day clock, and a region that's been violating its own ceasefires repeatedly. Markets have priced in optimism, energy prices have fallen, swap rates have followed, and lenders have cut rates. That chain reaction is good news for anyone looking to fix a mortgage rate right now. 9 lenders moved this week. The best 5-year fixes are approaching 4%. A few months ago, that looked a long way away. Inflation at 2.8% gives the bank cover to hold. The 7-2 vote tells you the risk hasn't gone away. 2 members wanted a hike yesterday. If energy prices spike again, that minority could become a majority. House prices are being flattered by a base effect, but the underlying market is functioning. Approvals are up, but sellers are discounting asking prices to compete, and that combination rarely lasts. My view is that the window for borrowers is open right now. Rates are moving in the right direction, and lender competition is real. The peace deal, however imperfect, has given the market some breathing room. But this is not a situation where patience is automatically rewarded. The Strait of Hormuz could close again tomorrow. Hezbollah and Israel are still exchanging fire, and the 60-day clock on the US-Iran deal is ticking. Lock in a rate, keep it under review, and speak to a broker who can switch you to something better if it appears before you complete on your mortgage. Now, who benefits most this week? Well, remortgages coming off fixed deals in the next 6 months. You can lock in now and switch down if rates improve further. With 9 lenders cutting simultaneously, competition is working in your favour. First-time buyers with a deposit ready, sellers discounting, plus a broader product range, plus improved rates. That's a reasonable entry point. Buy-to-let landlords. Kensington and TMW both cut this week, specifically in the buy-to-let space. The specialist market is starting to move again. And anyone sitting on standard variable rate, the average SVR is around 7.15%. The best 5-year fix is below 4.5%. That gap is costing you hundreds of pounds a month, so just get in touch with a broker. Well, that's your week. Bank holds, lenders cut, peace deal wobbles, but markets take the positive read. If you found this useful, please do subscribe, share it with someone who needs it, and I'll see you the same time next week. Take care.